All right. Welcome back. We're at, I think, episode 3 of Avoid Crisis podcast with Alan Plyler and myself, Ray Arellano. Gosh, it seems like so much keeps happening so fast. we could do this multiple times per week.
Yeah, really. I mean, I don't know about you, but I am absolutely consumed at how many things I'm seeing. It's almost like a whirlwind. Just so much information, so many things, and in the whole theme of Avoid Crisis, looking at this and saying, can we put some things together, kind of see a theme, talk about what kind of risk may be there, maybe what actions might be important to think about now, maybe do to help to avoid a crisis, because it just seems like we're either heading towards something, we're already in it, don't know it, or maybe it's to come, it's developing, and we're not sure just exactly what it is. But, and we can start, we talked about a number of different things. We can start almost anywhere, but it just, every day it seems like there's something else. And it's like, we talked a little bit earlier and said, hey, here's some things we could talk about in the show today. I'm going to let you start because, this is ping pong. Verbal ping pong going back and forth.
I've got a good entry point. Hold on. I need to pause our recording for 1 second. Give me just a second here. But Alan, in that intro, you made an interesting point, and I think it's worth a pause to give some context, because the concept that we're going to be driving at in a number of episodes, and it's not just related to banking, it's not just related to business or corporate finance or finance in general. It's Avoid Crisis has so many other facets to it. And we are going to delve into those in future episodes, but this banking thing and the financial thing seems to be the topic of the day. But one of the concepts I think that you threw out there that's really important, and I want to make sure that our listeners kind of key in on here, is that, yeah, we are in the middle of it. And it's really hard to separate like what's good information from bad information at any moment in time whenever you're dealing with something and you are trying to essentially avoid a crisis, avoid a disaster. And we find ourselves in the middle of this now. If you go into the future and you look back, you're going to go, oh yeah, look at all these signs that were there. Look at all this information in their 10Ks and 10Qs and, and reports and whatever. And if you go look at the short sellers and the options trading and so on, you can start to piece things together. But at any given moment in time, there's such a tidal wave of information now, particularly with the internet, good and bad information, that it's really difficult to be able to focus in and to see macro issues and to be able to avoid crises. So, we're handling these topics real time, but I think that's super important because that's life. That's real life. But to be able to make that context that this is real world, real time versus we're going to take a very narrow, singular topic. We're going to look back historically and we're going to say, well, why didn't everybody see this? It doesn't work that way.
Yeah. I think you have to be even more careful now on what I'll call the information that you're receiving and how you interpret that, because you may not know who's writing it and why and what their agenda is. And one of the things that we've talked about, I think we talked about this in one of the early episodes, was we were talking about this whole path of when you're in the middle of something where you get this sense of this is a disaster potentially, right? And then all of a sudden you have a whole group of people coming out and saying, no, it's not a disaster. This is an isolated event. You should really just look at it as an isolated event. And we have talked about, for instance, this coming in a sense of threes, right? First of all, FTX, Then we saw the SVB and Signature Bank. I mean, just 1, 2, 3, but in a relatively short time period. And one of the things we were talking about in an earlier podcast was that these have tentacles. They go deep. It's not just California. We talked about it before. We said, it's going to be the U.S. It's going to be banks, regional banks. It's going to be big banks. They're going to be winners and losers. And this has the risk of contagion around the world. And then we saw Credit Suisse. We saw the CDS, credit default swaps go up in value, and they're, insurance against potential default, the bonds generally from the banks, but they were a precursor to a lot of trouble in the financial crisis. We're seeing it again, credit default swaps. We saw it with Credit Suisse, and very shortly after, I mean, this large institution, we talked about this earlier in the podcast as well, a large institution, been around for a long time, and there was inherent risk there. The enterprise value built up for quite a long time, 39 and a half years or so for SVB Bank. That brand, that reputation, in a very short time was eroded. We'll see what happens this weekend, right? I mean, there's discussion that there's things happening at Deutsche Bank. There's discussion that perhaps there might be some sale of assets for SVB. I mean, you can start anywhere. I'm just saying
let's finish that thread that kind of started this. The SVB sale. It's like they had a deal, they stopped it, then they went and did another one. It's like, what's going on there?
Well, I mean, if you look at that and you just look at the history, what happened is FDIC comes in, and the very first question is, okay, what are they supposed to do? Well, they're supposed to make sure that the depositors, find out if the depositors have $250,000 or less, right? Make them whole. And then it went from that to say, wait a minute, what about all the other depositors? I mean, what would end up happening if those depositors were at risk with their deposits? And so then all of a sudden we had additional efforts that went around trying to say, okay, the depositors are going to be okay there. And then we were told that, from the U.S. government with Biden saying that, these deposits are going to be safe. Was it guarantee, or is it just, can we really count on it? I mean, if we were to go and look at all of the banks out there and say, what is the risk? I mean, what we were talking about before is if it happens here and it happens that quickly, especially in today's world where we can transfer electronically. And we saw that some people were getting ahead of others in that whole process, at least with SVB, right? But we talked about, if you move your money around to different places and you keep it under 250,000, well, you're going to be theoretically protected by the FDIC. But there's a question of, the backstop. At what point do they not have money themselves? Because if you think about it, where is all the money, and where, you have it in a digital form that says this is how much you have, and it looks really good, right? I'm just saying, if you have 10 million, you look at it in the bank account and you're like, okay, from whatever source that is, I got 10 million, but do you really? Because if you go to pull it out, what ends up happening? And so that question has been something that a lot of people have just never really thought that much about. And now, where do I keep my money is like a really, really big question on a lot of people's minds. What I'm surprised about is how many times I've heard, just like overheard conversations. You're just walking down the street and you hear somebody talking about banks. You hear them talking about, I got to get my money out. And, you have the whole thing about, I know we're not in a crisis now. I absolutely know we're not in a crisis, okay? We're in the middle of something, but it's not an absolute crisis. It's not the same as 2008, but we don't know what it could develop. But here's how I know. I haven't gotten a call from my mother yet saying, should I take my money out of this local bank and put it into some, large bank? But,
or under my mattress, right?
Yeah.
It's super true. I mean, and with the general public's getting a big education on the banking system. It cracks me up. I was in a conversation a few days ago. I can't believe how a bank, if someone deposits the money, that they don't have the money to give back to the people who put it in their bank account. I'm like, do you have any idea how banking works? It's like you walk in with a lump of cash and you put it in your account. You think they just leaving that in the back in the safe, waiting for people to come get it? It's like, that's not how it works. You know, they got to put that money to work.
Trust. It's an inherent trust, but it has to be backed by something. And what is the backstop? You know, I mean, FDIC is only a portion of the backstop. I know that we talked in an earlier podcast, and you're like, okay, does 250,000 make sense anymore? Last time it was raised was back in 2008, right? And you know, and if you go back to trying to do inflation adjustment, you know, what should it be now? But again, it was designed to like really handle the small guy. But what about the fact that there has been a lot more people with a lot more balances higher than that who, you know, are going to have to do something with the money if they don't want it to be an uninsured deposit.
Right. And then, yeah, it's a really interesting concept. We talked about it last time about raising the 250 limit. There's been talk about it since that last episode. I'll tell you, I think somebody's got to be listening in, even though we're just recording these on our own. Mm-hmm. By the way, for the record, right, we might as well just throw this one out there. Today's Friday, March the 24th at about 1:30 in the afternoon Pacific Daylight Time, just to date and timestamp our recordings, because by the time we get this stuff posted up, there's going to be a little bit of lag here. So that's the SVB assets.
Let me go back.
Go ahead.
Let me go back on that a little bit on the SVB Bank and the Bridge Bank, and they're looking to sell those assets, right? But they were expecting to sell it to another bank, and maybe we'll hear news come Monday morning about potential investors, buyers, whatever they're trying to do, you know, try to get the best value for that. But the point that we talked about before, relating to, you know, what happens to the warrants that they had on these companies? They're in the innovation space. What's the intellectual property that they hold? What's that future value that can't be monetized today? Is someone getting a bargain? You know, we talk about winners and losers. If they did buy, are they getting a bargain? Or, you know, is it structured in such a way that there's going to be something that we'll look back and say, you know, they really should have done it that way? Because it seems like it's a really difficult thing for them to accomplish. And so when we were talking about there's got to be some repercussions, the other thing too is, remember whenever this kind of was looked at as though there's assets there that have a certain amount of risk, and do you understand that risk? And then other regional banks were looked at like, okay, do you have deposit flight risk? But then they started looking at what is your base of lending and what's the risk inherent in that. And so take, for example, First Republic Bank in San Francisco, headquartered in San Francisco, that has suffered tremendously with their stock value, right? We talked a little bit about that. And then we saw the banks who came to their support. I'm not going to say rescue, but they came to support them. And they put in $30 billion. That seems like a big number. I mean, it's a vote of confidence of some sort, right? But how many other banks out there would get that kind of support? I mean, there's a lot of money moving around, but it's not changing the fundamental risk that's really existing. So if you move your money out of a regional bank and you put it into a big bank, have you then said, okay, now I'm safe? You still have an uninsured deposit. And how big do you have to be before someone comes along and goes, because of this or that, you're going to have to make changes in your entire business? As an example, Credit Suisse, right? I mean, if you started this year and said Credit Suisse is going to be around at the end of the year, 2023, you would have been wrong. And if you'd said Credit Suisse will be around in the form that it was by the end of the first quarter, you would have been wrong, because we're not even at the end of March. Right. Okay, so I mean, it's moving so fast. But go ahead, just, you know, other thoughts.
We've touched on a few, and I think the market, the societies trying to understand and digest what happened at Silicon Valley Bank and Signature, two different issues, by the way, and then identify similar risk patterns at other banks. And I think while there may be some similarities, there are some important differences. And I want to throw a quick concept out there, touch on FRB, and then we're going to jump to another bank. Everybody talks about the difference between correlation and causation. But I always add a third one. You don't hear this very often. I always say, is it correlation? Is it causation? Or is it coincidence? Right? Because it could be any of those. It doesn't have to be correlated or caused. It could just be a coincidence. And so you have to look at all these fact patterns as somewhat unique, having some similarities, but having unique characteristics. First Republic Bank has a big business among the venture capital and the private equity community. They have a lot of unsecured depositors, which, by the way, just quick definition of terms, an unsecured depositor is the amount of deposits they have, checking, savings, demand deposit accounts that are above the FDIC insurance limit. So one of the things that the market is looking at, they're saying, hey, how much of their demand deposit funds are above the FDIC insurance limit? How much of them are uninsured deposits? And what the theory is that people are going to begin moving these balances around such that they can now be at multiple banks and stay under the FDIC limit to ensure that their total cash position is insured across the banking system. Also in response to this, a number of banks have introduced or have expanded upon their sweep products, whereby they're automating the movement of money to other FDIC insured banks, but making it available at the primary demand deposit account. Earlier, when thing first blew up, $1 million, $1.5 million was pretty common. Just a couple of days ago, somebody announced one as high as 5 million. Obviously, the more banks you get, the higher you try to get that limit, 250 increments, the more complicated it gets to coordinate all this back end stuff. But thank you, technology. It does make it easier. So, $1 million, $1.5 million to 5 million, pretty easy. But still, you got to park the money somewhere.
Yeah. So just when you talk about a sweep account, can you maybe just help the listeners understand a little bit about what a sweep account does and why you would do a sweep?
Sure. And it was funny. I earlier had in my head confused the old days way back when, 20 years ago, the ZBA accounts, the zero balance accounts, and a sweep account. And they are different. So the ZBAs aren't really a thing anymore. So we'll just leave that off the discussion. Sweep accounts. What the bank is doing is you have a primary demand deposit account, so a checking account. And you're saying, I want to have this account, but I also want to have it FDIC insured, but I need to keep more than $250,000 in it. So you're going to sign up for a sweep account. Most banks call them ICSs. And so integrated consolidated sweep, I believe is what it's called, something like that. And so what the bank is doing kind of for you on the back end is have these relationships with other FDIC insured banks, and they're moving the money over there. And then if you have a high and low limit, so you say, look, I never want my checking account under, 100,000, but I never want it over 250. So to the extent that it hits the bottom, it'll pull money from this other account to put it back in. And to the extent it gets over 250, it'll pour over into another one of these FDIC insured accounts at another bank. It's all transparent to the account holder. You don't do anything. You don't necessarily see it. But in the documents, when you sign for the account, it's going to explain and describe all this out for you. A lot of them, because there's a little more back end to it, they're as a minimum. So you can't just go and say, hey, I have $50. I want to open a sweep account. It's usually $100,000 to get into a sweep product. And then because there's so much money involved, though, they will also offer a percentage. So right now you can get into the mid to high 3 percentile. Of course, with another topic, with the latest 25 basis point increase we had this past week, maybe that's getting closer to, I don't know, 4.5%, 5%. Who knows what these sweeps are? But anyway, that's what a sweep product is. You can earn some interest, so diversify your risk.
Okay, we talked before about winners and losers, and we also talked about take the information that you see, think about this as far as avoiding crisis, and try to put all these things together and say, what maybe could that mean? So one of the things you just said was that for the bank customer who has enough money to where this has been an advantage for them to sweep in the way that you're talking about these higher amounts, what they're doing potentially, I'll just simplify the example. Maybe they had, just say, 10 million, and they had it all in one bank. So they only had 250,000 of insured deposit with the FDIC, right? Now, as they start to spread that out, they're actually gaining a higher amount of insured deposit compared to their uninsured deposit. Follow the math there, right? But winners and losers, who's on the other side of it? Think about the FDIC themselves, who would look at this and say, if everything was to happen today and we had to pay out everything, that all insured depositors, we would pay out X. And this is before what we saw in SVP, right? So it would have been this. But now as people spread it out all over the place, what is their theoretical liability? Now it's not just 250,000 on this one individual, but multiplied by how many people have been moving it around. And just think about what this is doing to inflate the liability side of the obligation that the FDIC has. And so ultimately, who has that obligation? The FDIC is a government entity, private enterprise, publicly traded.
No, not publicly traded. It's a quasi-government entity, right? It gets its funding not from taxpayers. It gets its funding from participatory banks in paying fees. They pay like insurance premiums, if you will. It's this group insurance for the whole industry. So, it is not a taxpayer bailout when the FDIC steps in. But as we all know, in a capitalist economy, if you have extra expenses and you still want to maintain a profit, then you have to charge more for your services. So the banks are going to build this into the fees that they charge. Right. That's all.
Right.
And you're right. And I think
go ahead.
Part of the theory, though, about moving the money around is that we're not going to have runs on multiple banks at the same time. I think if people move their money around, what you're gaining from that is that if a single bank fails or has difficulty, then you have stability because at least you have another chunk of money somewhere else. And as an example, in a number of our clients and on a couple of boards that I sit on over the last couple of weeks, we've had discussions about this very topic. And essentially what you arrive at is, look, you have to spread the risk around. Today, not if you have over the FDIC limit, you're a fool. You got to spread it around. But so you have to minimize the risk. At the same time, though, you can't do it to such an extent that it makes your operations, unmanageable. You got 20 accounts to reconcile, got stuff moving in and out. You have to have some order to it, how you're going to do it and make it make sense, right? So you have to do it in a way that's operationally efficient. And then at the same time, you do want to try to either minimize costs or even on the positive side, maximize your return. So if there's going to be some kind of interest paid on a sweep product, go for that. So minimize risk, manage operations, and maximize your return. And then now go for it and go open up a couple bank accounts and integrate it with all your accounting apps and software and your payment apps and payroll and all this other stuff. And there you go. That's what you got to do today. And then if there's a run on a given bank, all you got to do is go into all your apps. You switch over. Where's payroll going to draw from this week? Oh, not that bank. They're having problems. We're going to go from this other bank that's already set up. It's already funded. It's set to go.
So I want to go back to your mention on the most recent interest rate decision, 25 bips moving up, right? And we
Mhm,
talked in a prior podcast about this, and we said there's three scenarios, right? Could go up, could stay the same, it's pause, could actually have a cut. What we saw was the quarter point. Previously, the market was anticipating up to a 50 pips increase. ECU came out with 50 bips, and they're fighting inflation. That's why they said they had to do that. The U.S. being in the same spot, they felt like they needed to raise. And you would think that that would make things a little bit better for banks, because now they have potentially a better margin, right? And maybe the demand for loans is going down potentially. So, they're going to make up a little bit from their spread because rates are a little bit higher. But when you look at First Republic and you think about, if they have a lot of exposure to real estate, maybe this is commercial real estate, maybe it's mortgages that are in the Bay Area. If you think about that, when the rates go up, the purchasing power that an individual has, for instance, of buying a residence, may go down and may be harder for them to buy. And so then, these values that they have in the mortgages, right? That's the collateral for their loans. I mean, I think there's a whole other part of this that is what people are concerned about. But I think another thing too is if you look at this from the way the market has reacted, and equity holders have risk, right? And the stock has, for First Republic, has come down tremendously, but it's been very volatile, right? I mean, in the last several weeks, it's been up and down. It seems to now be settled a little bit more towards the bottom, but we don't know, right? And what you have is you still have, even in these regional banks, the opportunity for individuals or institutions, as far as that goes, to come in and to short the stock, meaning they sell the stock first and they have to buy it later. Mm-hmm. If that is the entry point today, you would have possibly been shorting the stock at somewhere between $12 and $12.29, let's say. Mm-hmm. That's the maximum gain that you can get if you're to short the stocks. Now, one of the things to remember is in the financial crisis, they were so concerned about how the values of these banks were going down. I mean, even to the point of getting to their tangible book value, maybe even less. They came out and said you can't short the bank stocks. Right. What would end up happening if somehow someone got the idea that you could not short the regional banks, as an example? So you could take a short position. It doesn't mean that if you were short that you, it just would mean that you couldn't actually expand your short position. So no new shorts, right? That would probably put in potentially a bottom. But if you were short the stock, you would at some point need to buy those shares back as long as they were still in business, right?
Yep.
And as low as this, just take again, First Republic Bank is, I mean, is there any risk if someone was shorting these stocks that, there could be what they call maybe a short squeeze or anything like that? I mean, what's your thought on that?
It's hitting numbers that I don't quite get it. My understanding, well, this is a data point. I believe today in intraday trading, that FRC, which is the ticker symbol for First Republic Bank, hit a new low, right? So yeah, to your point of volatility, it ain't out of the woods yet. My understanding is that it's gotten to a point where the market cap is below the assets on the balance sheet, and we're talking about current assets on the balance sheet, not the long-term stuff, that might be underwater, stuff like that. So clearly there's some psychology going on here. There may be timing issues. I think that there may be people speculating that because FRB focuses on a lot of high net worth people, uninsured depositors, right? Their number was a little higher than industry averages. That they're thinking that a lot of this money is going to leave the bank and go elsewhere. On the other side, though, First Republic customers tend to be very loyal, and you hear repeatedly. You don't hear this with many banks, but you hear repeatedly how the customers love First Republic, and so there's something's going to give here. Now, which one is it? We're going to end up in a short squeeze. I think at some point we are. I think people are letting this thing crater and bottom out, and then at some point it's going to be a glom on, and I think this thing's going to pop up. It's not going to go through the stratosphere or anything. I think it'll pop up pretty quickly to say about 40, and then how it gets from 40 to 80 is going to be interesting. Remember, all along the way here, next week is the end of the month into first quarter, so we're going to start getting some numbers out within a month of today, and that's going to change a lot of stuff.
Yeah, I mean, the March 31st is the close of the quarter, but it's also when the short report gets calculated, meaning like how many shares are short, and not too long after that news will come out, and people will be able to take a look at it and say, well, if there's that many people short and the float is this, and they do calculations right that. But here's the thing that I was saying too. I mean, let's just call it the low right now, and let's just call it somewhere around 12. You have $12 in the downside if you're 100% right, and this is the end of this particular institution from a stock standpoint. You have 12 points. Okay, what's the limit on the other side? There's no limit. Okay, now here's the other thing. You just may get a chance to have something happen that we never thought could happen. As I just said, if you're short on this, you can only short it to zero. But I'm going to remind you that we didn't think that interest rates could go below zero, and they did. So could this be the first stock that we've ever seen to be able to trade below zero? I just don't know.
Yeah, that's kind of mind-boggling. Let's unless there's anything else on First Republic to talk about.
No,
let's finish up our final bank on the list. I think to talk about this week, Deutsche Bank.
Yeah. Okay.
Because we hit on Credit Suisse a little earlier.
Yeah,
that's kind of a known thing. Kind of keep moving along. Deutsche Bank. What the heck?
Yeah. Let's go back to the shorts. When the trade is in play, then there's a lot of people researching, and they're trying to find who's the next vulnerable in that category. So the category is banks, and this category seems to be large European banks. And so you had Credit Suisse, and it's kind of hard to go after UBS right now, right? But you got Banco Santander and then a couple of others out there that are, big banks, but they're on the list. So you can find a reason to be worried. Is it real? I mean, but, we don't know. We don't know if there's something that somebody knows and sees and says, okay, there's a real reason. We'll find that out. But it is a part of saying what we were talking about before. It starts, somewhere, and it starts to spread because we're so interconnected on a global basis, right? Do you trace it back to one of the three that we talked about? FTX, SVB, Signature? I mean, does something go from there? Or is it just that there's a higher awareness? Or is it also related somehow to the uncertainty that we're seeing? And I'll even point to Paris on this. The pensioners, the reforms that they're talking about with Macron. I mean, that creates instability. I mean, the other thing that's happening here is that the people are, and when I talk about the people of any government really need to be able to believe and rely on their government. Things like social services, et cetera, and your retirement plan. I mean, right now in the U.S., if all of a sudden you said, okay, for Social Security, now the retirement age is 80, and there'd be a reaction. I think there's going to be a reaction at 75, at 70. Now, the thing is that somebody gets an idea, they put it in, and going back to the 0% interest rates, right, the negative interest rates, did that only show up in one place, or did all of a sudden it end up in a number of different places, and eventually this got unwound, and it was looked at as temporary. These aren't temporary changes that are being proposed. And there's this impact to our faith in the government. And we're having a question here in the faith of our banks. But if you extend that question of faith, that question of faith goes to the government level as well. Are we going to have backstops for all deposits in America? Say yes, please.
Yes.
Okay, well, I don't think you have the authority to do that, but okay, I'll go with that. You're making me feel better. So,
we actually, we can talk about that in a minute about Powell. You talked about short squeeze earlier, and it kind of gets into, in a way, some of the meme stock stuff, and kind of playing in this financial space. We had a lot of movement on Square the last couple of days, and Hindenburg Report, etc. The short sellers are glomming on, and it's like, so. What's your take on that? I don't know of any fundamental reason why Square should be getting hit like this. I think that my understanding of their business and what I've read and seen is that they're really strong. They're one of the top payment platforms for small businesses and e-commerce. Do you know what's your take on what happened with Hindenburg and Square?
Well, first of all, if you read the Hindenburg Report and you start looking at some of those things, you're going to be surprised at what they're saying, and you have to put it into context of, no one sends Christmas cards to the short sellers, and no one says Happy New Year to the short sellers, and India. And we can go into that. And a lot of people don't really know that much about how Hindenburg had an impact with somebody who was a billionaire in India, and the ultimate result of the decrease in value of their wealth through that. I mean, the main individual, Jack Dorsey, took a $500 million hit just in the market moves as a result of this report coming out. I actually have some things where they're talking about. The big thing that they talk about is about Cash App. And Square went through a lot of different changes, including its name change to Block. So it's really about Block. And the Hindenburg Report is extensive. And what it showed in their commentary, because I'm just going to call it commentary, so more to be seen about who's going to say that that's correct or not correct. But when they put it together in such a way that it's point after point after point. And it's really, when you look at it, you say, okay, you have to defend on all these. You have to go point by point in reaction to it. And if you try to go point by point, you get into a very long explanation on some of these things. Let me just give you an example. I'm going to read from specific portions of the Hindenburg Report right now. They're going to talk about Cash App. So Cash App is really where you're able to transfer money from one person to another. And by the way, I really looked a little bit into this, and I saw that even in their advertisements, they were saying, about what Cash App did. They talked about how your deposits were insured, and they talked about FDIC insurance. And I'm like, wait a minute, haven't I heard of this FDIC guy before? But here, I'll read you a couple things. Cash App was also cited by far, and they put that in quotes, as the top app used in reported U.S. sex trafficking. According to the leading nonprofit organization, multiple Department of Justice complaints outline how Cash App has been used to facilitate sex trafficking, including sex trafficking of minors. Okay, so you're going to have to deal with, responding to that. This is another one here, there's even a gang named after Cash App. In 2021, Baltimore authorities charged members of the Cash App gang with distribution of fentanyl in a West Baltimore neighborhood, according to news reports and criminal records. And they go into more detail about, for instance, rappers referring to Cash App. They go into, potentially other issues. But a big part of this is this next section I'm going to talk about. So another bullet point. They do this bullet point by bullet point. So just imagine, boom, boom, boom. And you have to go back and you have to come up with your story, which, by the way, they've already responded and saying, this is just another short seller out there trying to make money on the downside of our stock. But here, let me go to another point that they said. Beyond facilitating payments for criminal activity, the platform has been overrun with scam accounts and fake users, according to numerous interviews with former employees. Examples of obvious distortions, this is the next bullet point. Examples of obvious distortions abound. Jack Dorsey has multiple fake accounts, including some that appear aimed at scamming Cash App users. Elon Musk and Donald Trump have dozens. Next bullet point. To test this, we turned our accounts into Donald Trump and Elon Musk, and were easily able to send and receive money. We ordered a cash card under our obviously fake Donald Trump account, checking to see if Cash App's compliance would take issue. The card promptly arrived in the mail. I mean, there's a lot more. I mean, we could spend a lot of time just talking about this, but the thing to remember about this is that, when you have somebody who goes and spends as much time as the authors of this particular report have spent talking to former employees and detailing in the way that they do. I mean, they have graphics and they have pictures, and they're showing how one user could have had multiple accounts. And so you just think about it, and where this ties in goes back to the SEC. I'm going to tell you about this part too. There's a whole set of allegations that are about the metrics that were used, non-GAAP metrics, how more and more the non-GAAP metrics were supporting the growth. The company had stock that moved up quite a bit. Obviously, you have insiders selling under whatever plans are selling at those times, but they're also talking about their growth. And what they're saying in this report is that growth was relying on accounts that were fake. Now, where did we hear about fake accounts before? And that having a question of value? Was it a company called Twitter? I mean, I think that's what it was. And how does the tie-in come in here? I mean, this Block CEO and Square CEO and Twitter CEO, Jack Dorsey, fake accounts, and Twitter was one accusation. We've got another accusation of fake accounts here. This is a public company. Twitter was public before going private through the sale. There's just a lot of different things in here. And the take of this is that it's not going to be that easily dismissed. But I'll add something else to this. Block also was really involved in looking at the advancement of crypto. And what we heard just even today from the SEC was a warning. And the warning says this: stay away from crypto. Now, whether the SEC is right or not, I mean, it also brings up another big question. And I don't think we even had this on our list about the Wells notice that Coinbase got. It looks like this is going to go to potentially the courts, where the SEC informed them through the Wells notice that there's potential enforcement action. And Coinbase is ready to sue the SEC over that. So that's going to potentially put a lot of this issue of, what is a security? What's an unregistered security? It's going to put it in the hands of the court. And, you go back about a lot of this with crypto, and you just think, what happened with FTX? There's involvement with crypto there. There's, this debate going back and forth. And then what do you do with your money right now? Some people might think, well, I'm going to go and I'm going to take my uninsured deposit. I'm going to invest in something else, right? What should that something else be?
Not crypto. Let's just put it that way.
Well, I mean, you want to avoid a crisis. I'm just saying that there's so much that's going around, right? And you think about, okay, I'm going to avoid one risk. And by doing that, you have to say, what's the acceptable risk I'm going to have, right?
That's
I
right.
mean, and the same thing we're talking about avoiding a crisis. If you take all of your marginable marginable balances in a trading account, and you're allowed to short, as an example, and you decide you're going to short the regional banks or the regional short bank index, and then there's a squeeze, you're going to have to, more than likely, come up with some money. And if you don't have cash on the side, you don't have those deposits you can rely on, then maybe you're going to have to get a loan from the bank, and they're going to charge you an interest rate that's aligned with the interest rates as they're moving now. So, I mean, this is how you end up in a crisis if you're not thinking through all these different things. And
Yep. Yeah, to a couple of points to clarify here on this, just for the listeners. A Wells notice is a type of notice issued by the Securities and Exchange Commission about enforcement action. A Wells notice has nothing to do with Wells Fargo Bank, just to kind of put that out there. And yeah, so SEC is crawling all over Coinbase, and I think it's safe to say in the concept of avoid crisis, that if you're going to put some money into crypto, that it should be pure gambling money that if you lost all of it, it would not affect your life or lifestyle. If you hit a big upside, good for you, bonus. And if you lost all of it, it's not going to bother you very much. It's like, I lost $20 or whatever. So that's a quick thing on my opinion, on the crypto side and avoid crisis. Yep. and what's going on there. I
want to jump into something else that we talked about, which is this, and I'm sure you've got a lot of things to talk about too, and I don't want to cut you off from it, but I know that this kind of goes along the lines that we've had in the discussions before about rates and talking about the raising of rates for inflation. And I want to talk about this issue that we have with inflation around the world, because I was trying to figure out, just by looking at the news and looking at the facts and saying, why was the ECU coming out with their raise of 50 basis points, and where would it potentially stop? So here's some interesting things about inflation around the world. Right now, in the United Kingdom, it's estimated to be at a rate of 10.4%. And that was a rise from 10.1%. In the United States right now, it's estimated that the inflation rate is around 6%, which happens to be the 8th lowest in the world. Now, I'm going to ask you what you think the estimated inflation rate is in China. Okay, what do you think?
I have no idea, but they're going through all kinds of stuff. Yeah. The COVID increases, the air bubble going through. They had a real estate crash, but they've got other problems. They've probably been pumping support into the system somehow. I'm just going to pick a round number, and I'm going to say 10%.
Okay. All good arguments for why it could be higher, but it's being estimated by the same group of people, the numbers I'm quoting here, at 1%. Okay?
What?
1. Yeah. But here's the thing, right? Maybe they're in a slowdown in a lot bigger way than we think. And maybe, this interest rate rise is going to slow things down. But inflation around the world is happening. Even at 1%, there's no reason why it could all of a sudden jump in China. Mm-hmm. Okay, I'm going to throw out another country.
Okay.
Argentina. What do you think that is?
Oh, boy. Oh, gosh. I was just looking at this. There's a South American country that's dealing with hyperinflation right now. I don't know who it is, but we're gonna play this game here. I want to play the game version of the game, not the, and that is that you wouldn't ask me unless it was an outlier. And if I remember correctly, the country that I had read this on, I thought they were like 70, 80% annualized inflation rate. So I'm going to say 75%.
You're getting close. In Argentina right now, it's estimated at 102.5%. Yeah. How do you deal with that? I mean, maybe we'll be able to talk to some people in Argentina and ask them how they deal with it. I mean, it's a crazy. I've seen articles where they talk about it. And here's the thing about avoiding crisis too. If we look at the fact that it can go like that in different areas in the country, and we can have this very disproportionate, 100% in one country and 1% in another, but we're just, take the average between the United Kingdom and the United States and just say, 10.46, make it 8. Just say globally, if we're in like an 8% inflation risk environment, what do you do? I mean, what do you do to fight inflation and avoid a crisis?
Well, I mean, the tools that we presently have and the economic theory that we have, it's, the seesaw, the teeter-totter of the rate, the interest rate versus unemployment. So you got to raise interest rates. You got to swallow your medicine, raise interest rates. That puts friction, downward pressure on demand. And as demand goes down, then so should prices, right? In the supply and demand traditional economics. So you raise rates. So what do you do with higher inflation? You got to raise rates, interest rates, and you have to swallow the pill of some increased unemployment. We're actually at pretty high employment rate. I would venture to call it full employment. We are at full employment. So we've experienced the pain of inflation. We're going to have a new pain that's going to start coming up, and you're seeing it already. Look in the last 2 weeks, the number of companies that have announced layoffs. Those layoffs are real. And as each company announces, the next guy is going to go, just like a run on the bank. They're going to go, well, heck, I don't want to be the last one to tighten my belt, and tighten my seatbelt and manage for this turbulent ride that we have in the economy coming up. I'm gonna hunker down as well. All right, we're gonna do some layoffs, and so it's gonna tip some people to a decision that they might have been kind of on the fence and just pushing and waiting and see what the tea leaves say, and all of a sudden they're like, okay, dude, we got to do it. C-suite discussions. We got to do it.
Yeah.
And then that's just, again, it's like a run on the bank. It's just a snowball. One begets the other, and here you go.
Yeah.
Now you have a recession.
I can't believe how quickly an hour passes when we get into these topics. And it feels like we haven't really even started to really dive in.
I know. We didn't harsh on Powell yet. We were talking really about, we got to talk about regional banks, big banks.
We got a lot to talk about. Let's do a quick recap. Okay. I mean, just some of the things we talked about today, right? And all in the spirit of avoiding the crisis. One, I think a point was that there's so many things happening, and the risks are becoming more and more elevated in observations and understandings, and we still don't know as much as we'd like to know. Two, that the change and the pace of the change of events that have impact is really observable. And we're going to know even next week before our next podcast about some new information on what happened with the bank sale and the bridge bank with the SVB. We're going to find out something, even if it's that nothing happened or that something happened. And we'll have a lot to talk about there. We're still in the window of raising rates. Although the market thinks that 25 was a move in the right direction, maybe they think it's going to be a pause next. We still have a lot to debate because it's a moving target. And there is inflation going on around the world. And at least looking at the way that rates have been coming up compared to the global rate, we're not there to where we're fully able to say that the rates are high enough to reduce the inflation spiral. All these things have to be kind of put into the view of, okay, if that's what we're seeing and observing, think through it. What do we have to do to avoid crisis? There's probably some other ones that I've missed here. Maybe you can add to them with any other thoughts, but I think that's a good recap of some of the things we talked about today.
I would just highlight on your first couple of points about information, and going back to, we made this comment earlier, is information age, the internet, Google knows everything, whatever, you can Google anything and get some information pretty quickly. Yes, we have access to more information, more financial reporting, more SEC reports, all kinds of stuff, good factual information. But there's also a bunch of crap out there. There's a bunch of, bad information, wrong information, some of it unintentional, some of it intentional. And so, again, getting back to, you're in the middle of all this storm and what's going on. How do you separate the good from the bad? You got to be really careful. You got to rely upon. You can get a thread of a story, a hint, a sniff of a story, but you got to go back to reliable sources. Okay, at the end of the day, trace that story back. Use more than one source. Use sources that are both conservative and liberal, that are both, blue and red, or whatever, however you want to slice and dice it, to get good information. Because I'll tell you, one of the fastest ways you'll find yourself in a crisis is relying on a single source of information or bad information. So, I want to throw that out there as we kind of wrap this up, is that be super careful about your information sources in your research. Do your own research and think for yourself at the end of the day.
All right. Well, it was great again. Just being able to talk about it. I've got so much to think about, but again, boy, it really goes fast.
Sounds great, Alan. Thanks again for another great episode. And we'll see everybody next time. All right. Bye-bye.
Bye.